Welcome back to AgriTalk. I'm Chip. Glad that you are with us on this Wednesday afternoon. We're going to talk big picture. We're going to talk about some markets that we typically don't get an opportunity to talk about on AgriTalk, and we're going to do it with Bill Baruch from Blue Line Futures. Bill, thank you so much for making time for us today. How are you, man?
I'm great. How are you doing? Thanks for having me on.
Yeah, I'm glad you're here. Hey, did I see on social that you were road tripping back from Augusta, Georgia this week?
I was down in Augusta for the Masters this past weekend. It was one beautiful course, beautiful time. Weather was great once we got past Thursday, and a very memorable experience.
That's outstanding. That's one tournament, as I understand. I've never been to it, but as I understand, that's one tournament where the where inflation just has left the concessions behind. Is that right?
Yeah, I mean, you could go in there. I mean, I think it was a couple bucks for a sandwich. You know, beer wasn't too expensive either. Like I said, memorable experience. I felt like I was part of the tournament. We were on the 18th tee box for the last couple of groups, and the sun was behind us, so our shadow was basically where Scotty Scheffler was teeing off the finish, and they told us we can't move. So that was pretty cool. It was a good experience.
Yeah, that is being part of it. That's being right in it right there, no doubt, no doubt. Good for you. Good for you, man. That sounds like a great trip. Great trip. Okay.
Yeah.
Okay. Um, Inflation and interest rates have been a a topic of conversation for quite some time here on AgriTalk, and I was planning on ramping it up this week. And holy smokes, Jay Powell did us a favor, I guess, yesterday and made the conversation a whole lot more interesting. Um, I I I want to. I'm going to start this a little bit differently than what I had planned, and that is by putting it this way: what's wrong with a period of stability in interest rates, Bill? Is there anything wrong with that?
Well, depends where they're stable from. I mean,
Yeah.
if we're stable at 5.25, 5.5%, and inflation is below 3, yes, CPI is above 3, closer to 4 in some arguments, but the Fed's preferred inflation indicator, core PCE, is annualized below 3, year over year below 3. Um, so, I mean, I think right now, if you want to cause a recession, which, you know, some arguments, Richmond Fed President Harker yesterday was talking about maybe, you know, that they would have to almost cause a recession. He may not have said those words, but I think that's what the market interpreted him as saying in order to slow some of the spending. If you want to cause a recession, you keep interest rates at 5.25, 5.5 with inflation. Let's call it 3%. And you know, that's why I think right now bringing interest rates down. I believe the Fed also thinks that they are restrictive at this territory. So, you know, Powell yesterday is a bit speaking out of both sides of his mouth because of the market's reaction function. They can't let the market know their intention. Plus, they want to see more data. So I think stable interest rates, but it depends where we look to be stable from. I think they can settle in a little lower here. And that's why I think the cuts are still on the board this year.
Really? Even though
Yeah.
he's basically out and saying that it's not going to happen. See, I've been in the camp for a long time, Bill, that interest rates are going to have to stay high at least until the end of the year, and then we'll take a look at reevaluating interest rates and where they should be in 2025. I just didn't anticipate a whole lot of movement this year. If if we see those interest rate cuts, isn't it giving the markets something that maybe they don't deserve? Because interest rate cuts are normally reserved for a time when the economy needs a boost, and I'm not too sure it does.
Well, I think we can all agree that there are stresses within the economy, stresses on the lower people making lower wages, stresses within the banking sector. But let's focus on the sort of haves and have-nots here. You know, if there's a top 10% of people out there that are very comfortable. Now even look at the top, maybe 5%. I think there was a survey that if you have $10 million or more in your bank account, you're in the top 5%. And those people, I think, account for a tremendous amount of spending. But if you have $10 million or more in your bank account, and you're able to get risk-free 5%, you're making $500,000 a year risk-free. You almost really don't even have to work, and you're spending money. So I think there's pressure within the economy right now with interest rates hanging up here, where a lot of these services being driven are from the haves. And almost in some degree, bringing interest rates down would force people to spend less. I think it's a sort of a let's stop thinking two-dimensional and start thinking 3D and 4D, because I think that is something here. Now people could say, okay, interest rates coming down would even balloon the housing sector a bit more. Well, I think there is a lot of pent-up demand within the housing sector that may if interest rates come down, and may create activity and drive up prices for a shorter period of time. But I think there is a pie of demand. It's not an infinite pie. So I think once that activity takes place over a 6-month or 9-month time frame, I think then housing prices can come down. So I actually think the opposite. I think that interest rates at this level are driving the economy and actually creating a larger divergence between the haves and the have-nots here. I mean, imagine if you have more than 10 million, people who have $20 million in the bank account are making $1 million a year. Those are the people flying down to the Masters in private jets and spending all the money. So that's how you have to think about it here. And I think the Fed is thinking about it that way. And then there also is the banking stresses. The longer the shorter end rates and the inverted yield curve take place, I think you're going to start to see other skeletons pop up with the banking sector, which is also a fear, or the commercial real estate sector, which is also a fear of the Fed. So I think I'm looking from those angles and then saying, okay, well, why is Fed Chair Powell saying that we may not get interest rate cuts this year? Well, because that's the market reaction function. They can't let the market know when their intention, because the market will price it in before they're ready. I mean, if you look at it today, the CME Group Fed Watch Tool odds are still showing a 25 basis point cut in July with a 45% probability. So they're still looking at even pricing in 2 cuts this year. I think that is about right. And if the data continues to worsen or shows any worsening effect, or inflation shows this little bump up to be a blip, then we'll be quickly pricing in 3 or maybe 4 cuts again.
Okay. Oh man, interesting perspective on this, Bill. Definitely, it's let's bring it down to general average consumers out there. You know, the ones that are still a little worried about how they're going to put gas in the tank and pay for the grocery bills out there. What is this? What kind of an impact does this have on their lives? Not so much day to day, but month to month.
Well, I mean, inarguably, there is real inflation that's not being measured by the Fed's or the government's tools. I mean, we all know gasoline prices over the last month have risen, but by the measurements with seasonality, in the most recent PPI numbers, the government was trying to tell us that gasoline had dropped month over month. So, I mean, I think we all know that inflation prices, whether it's what you're paying at the pump, what you're paying in the grocery store, is impacting everybody. Now, the question is, what's really driving that? And I think, there obviously is some supply disruptions that have disrupted things. There's geopolitical concerns that have disrupted things. And I think a lot of that is really working through right now. I mean, there is, I believe, an effect too from the Red Sea and the shipping impact that happened earlier this year. That could have been a more of a cause on some of the rise in inflation. But again, I think when you're seeing the services spending, which has underpinned this economy for the last year, I think a lot of that's coming from what I spoke of, the people who are the haves. And then when you look at, I'll even go one step further, say the job market is distorted for 2 more reasons. You have those people that are the haves that now can make risk-free money. Now they can explore entrepreneurship. They can look at other ways to make money rather than being in an office and working a normal job, and then which then causes those those that need the employers that need to fill those voids to try and attract new employees to fill these higher end jobs, which creates wage pressures. We also have immigrants coming in and flooding. That is also creating more people in the job market. So on the jobless claims, and you look at the monthly payroll numbers, those are increasing surprisingly. There is more distortions out there causing this effect than I think that people want to really talk about.
Wow. Okay. Really cool. We are in the middle of a conversation with Bill Baruch from Blue Line Futures. Now, we got to break all this down and what it means for the trends in the commodity markets. And I want to spend some time, by request of listeners, talking about what's happening in the precious metals. We'll do that next. Welcome back to AgriTalk. We are in the middle of a conversation with Bill Baruch from Blue Line Futures. Big picture stuff is what we're getting into today. Bill, I want to jump onto this because there are so many different spots around the world right now that are delivering headlines to the global markets. All these geopolitical hotspots out there. Are they distractions to the markets, or are they real factors?
I think there are a little bit of both. It depends, what you are looking at. I do think that let's just start with the equity markets. Look at the equity markets, and you get a move that we've had in the past year and a half, where it's arguably was a little frothy a month and a half ago, and then we get a headline activity geopolitically, or just maybe it's something that's like a war-like headline, or maybe it is barbs being thrown between U.S. and China, as we're seeing with Biden in China here today. In that case, yeah, I think there's reason for people to take a little off the table. You're just people to see a little bit of selling. So those headlines, can impact it, but it doesn't change at the end of the day what the earnings we are going to see in the coming weeks. And I think that the market is reacting a bit, maybe profit taking because the headlines in anticipation of getting ready for earnings. Or you could take a look at a market like crude oil that is not as well supplied as it could be. And OPEC is taking production off. The U.S. has increased some production, but there could be disruptions. We have Iran in the mix. So yeah, I mean, I think there's definitely some geopolitical bidding underneath of crude oil, and then you take a look at the metals like gold, which we trade all of these at Blue Line Futures. We work with clients to trade these, and it's really easy getting set up with us, whether it's trading with us or trading. We run a commodity fund as well. Yep. that people can participate in. But I've cut my teeth trading gold since almost 20 years now, basically. And gold, it's really exciting to see the record highs this year. And I think you're seeing a combination of the geopolitical fears, the division that's taking place from a within. You look at the United States now separately. There's the BRICS, which Brazil, Russia, India, China, South Africa. The BRICS, I believe, they are buying gold. We know that China has added to their gold reserves for 17 months in a row. And I think this is, markets don't always have to react, how they should immediately. But when we look at Russia invading Ukraine, and we, there was seized assets of Russian oligarchs and things like that. Some of the markets react adversely than common sense would have thought. But in the aftermath, we're still dealing with the aftermath. And the aftermath is the fact that those assets were seized. I mean, it really underpins reasoning to have gold and make gold a part of your portfolio. And I'll tell you what, with the ranges that we've seen in gold and silver, as well as copper and platinum, I mean, I think we're getting into what is a commodity supercycle, but these are great tradable ranges that people can participate in too. So I think this is the type of market I've been waiting, for 20 years. It's tremendous to see, but it doesn't end at the metals. I mean, the commodities. I do think we're at the onset here of a commodity supercycle.
Okay, all right. I was going to say, the patience is paying off in the precious metals markets right now. There's no question about that. So congratulations on that. Um, okay, you mentioned what Biden is saying about China today. Is is it a legitimate risk or possibility? I guess depending on your perspective here, that the Biden administration is going to triple the tariffs on Chinese. What is it? It's steel and aluminum, right?
Yeah, yeah. Well, I think we haven't. Now, we've seen barbs being traded over the past year and a half, but
Mm-hmm.
we have not seen him really take a strong stance on tariffs in the headlines. And now, my question is what is the intention here? As he heads into an election season, we know that former President Trump, um, you know,
Yeah.
during much of his time in office, had pushed on the tariffs with China. So maybe
Right.
there's more of a political posturing here for campaign reasons. But I'll tell you what. I mean, I don't know if you've seen a chart of aluminum. We do own aluminum right now in one of the commodity funds that we run. I mean, that is a good looking chart. That thing has
Really.
really run up and has started to break out. The CME group does have aluminum offering. And I think when we look at copper and aluminum, I mean, those are two markets that have just started to awaken. I mean, from the demand, they're both very undersupplied.
Mm-hmm.
And I think, you look back about a month ago, China shut down smelters to stop producing the refined product of copper, high grade
Mm-hmm.
copper, which is what we trade, because the raw product is undersupplied. So I think there's trickling, and these are impacts of inflation. Even though copper has not been,
Mm-hmm. Mm-hmm.
really traded high relative to history in the past year and a half. I mean, these are sort of anecdotes of why inflation could be a little more steadfast and settle in at a higher level than what we've become accustomed to over the last decade. But also as our economies evolve, you need copper and aluminum and palladium, and they're being used in data centers for which kind of leads into the AI trade. So there's a
Mm-hmm.
lot intertwined here as our economies become more developed, and what commodities are going to be used in this ever evolving future of ours with AI and everything else we could imagine. But it's not, again, it doesn't just end there. I mean, look at things like coffee and cocoa recently. I mean, just now, I
Yeah.
mean, there's news that Vietnam is rationing the water. And I mean, look at coffee in the last couple of days. That's a market we've been playing. So I mean, there is. I mean, we missed cocoa, but I was going to. What's the next soft commodity to make the move? And I think all of these are anecdotes that lead into we are in a commodity super cycle. There is no better time to be trading commodities or
So
investing in commodities, even though U.S. ags have been a little bit disappointing. But
so when does this commodity cycle, when does it help the ag commodities, corn, soybeans, wheat, the basics?
yeah, yeah. I mean, I think right now, as from a sentiment standpoint, and I would really turn to one of my team members, Oliver Slope, who always joins you.
Mm-hmm.
But I do think that I think we're trying to bottom out here, I think too, if we could consolidate a bit and see some of the exhaustion from funds that are short and start short covering. Really at the end of the day, every rally starts to short cover. So we need, but what's going to start that first? Some positive fundamental news. So if we could see some positive fundamental news and anecdotes within the market, you could potentially start to see some short covering. I mean, maybe above that, the report, the end of March report, if we get above that high, that could be a line in the sand for some of the shorts,
Right.
and we could start to see that thing begin to run a bit.
Okay. All right. Bill, as we've been talking in the second segment, I've gotten two texts about this, and I I'm not one to talk about this very much, but they want me to ask you your thoughts on Bitcoin. Now, if you don't want to talk about it, just say so. But thoughts on Bitcoin?
Listen, I mean, I do believe that Bitcoin can have a place in a portfolio, and we do run a wealth management office, and I manage diversified portfolios with stocks and bonds
Yeah. Yeah.
and not commodities, and with the Bitcoin ETFs, it's something that we are discussing to potentially begin adding. With a 1% or a 2% slice into portfolios and get exposure to Bitcoin. Now, I think traditionally when you see any market run up as it has, the introduction of an ETF and the ability to now expose the broader audience to Bitcoin through an ETF has definitely been the catalyst this year for the price being driven, touching above 70,000 in that record high. We're now settling in, and it's not surprising to see the market settle in. Heck, we could really settle in as low as maybe 40,000 or so. It's some of the retracements technically. But I do think that we haven't seen the end of this rise in Bitcoin, and it's something that again we are addressing that it may serve as a purpose in our portfolios. Right now, we do have slices to gold and silver in our investment portfolios, not the commodity portfolios, but in our investment portfolios as well. So we're more focused on that. But it is nice to have an alternative. Now the question here about Bitcoin is it trades more like a risk asset than it does a hedge to risk aversion.
Yeah. Well, I'm just going to say this. Congratulations, Bill. You just had the first conversation about Bitcoin on AgriTalk, and I didn't choke and puke. So I I think I'm going to say that I survived it.
There you go. Hopefully we'll have many more to come. And we'll talk about gold and stocks and Bitcoin, all kind of make it all together. So we're not just throwing Bitcoin at you too much.
Yeah, well, thanks. I'll have to take it in small bite-sized pieces because right now it just feels like all it is numbers. I don't understand the value. I don't understand the change in value from day to day. I don't know what drives it, and it just is. It's an enigma to me, and I need to. I've been trying to understand it since it first showed up, and I still don't think I do. So we'll have to continue the conversation. Man, thank you for making time for us, Bill. Appreciate you.
Appreciate you. Thank you for having me on.
You bet. All right, that is Bill Baruch, Blue Line Futures. Like Bill said, every Thursday on the PM hour of AgriTalk, we've got Oliver Slope on here giving us his thoughts on what's going on in the grain markets, the livestock markets, and occasionally what's happening in the world of sports. All right, Davis and I will be right back to wrap up today's AgriTalk in a moment.